Tesla stock. Just buy Tesla, bro. Nothing else matters. Inflation, money printing, interest rates. Nothing matters. Just buy Tesla, bro. Did you like that? Welcome back to Strongman Personal Finance. I am Christopher Bell, certified public accountant. And yes, that means you should be impressed with me. Boglehead investor and hater of trash financial advice on YouTube. Now, I know I harp on Tesla a lot, but in this example, I'm not really talking about Tesla stock. What I'm talking about in this video is how inflation and rising interest rates tend to hurt growth stocks more than value stocks. Now, you may be like, Strongman, stop talking about Tesla. Well, I'm not going to until that stock dies. But I promise, this is not going to be solely about Tesla. So I made an Excel sheet, and I'm going to walk you through why inflation and high interest rates actually hurt growth stocks more. Oh, and by the way, there's a freaking, people are cutting the grass outside, so I apologize if you can hear it. So let's go check out this nifty spreadsheet that I made. All right. So before we dive into the numbers, I have two things here. I have a bond and I have a stock. Now, on the left is a United States Treasury bond or, Treasury note. And in this example, it pays 8%. Now, Treasuries are very safe. You know the government's going to pay you back, and they pay a certain interest rate. In this example, it's 8%. Now, if I were to say, hey, buddy or gal, I will pay you 8%, and I'll basically guarantee that you'll get that. Would you want to invest in a stock if you thought you couldn't get more than 8%? Because why would you invest in a great stock like Enron stock that may have 6 or 7% growth when you can invest in a bond, a completely safe bond that'll guarantee that you get 8%? Now, what that does is that impacts the required rate of return. So if somebody's going to invest in a great company like Enron, you're going to want a potential higher return than 8%. Because if you can't get 8%, you might as well just buy a freaking treasury. So stocks, when you discount the future cash flows of a stock, you want it to be higher than the treasury note because stocks are volatile. Stocks may fail. Companies may go out of business. You're taking on more risk by investing in a stock, which is why you want to beat the treasury rate. So the interest rate on the treasury bond or treasury notes or whatever, if interest rates go up, investors are going to demand a higher rate of return for stocks. And those people are really pissing me off that are cutting the grass, but whatever. Hopefully it's not too loud. So that's kind of the foundation of what we're going to talk about today. Now here on this cool, amazing diagram and chart that I made, I have some of my heroes that have inspired me and taught me so much that I now understand everything about discounting future cash flows at your required rate of return to find a good buy point for a stock. So on the top here, we have Jeremy Lefebvre. He's my hero. He actually gives you a great deal for his course. He only charges $20,000 and you get access to his Discord. It's a great deal. So if you haven't already, please go subscribe to Jeremy Lefebvre over at Financial Education. And come on, look at that hat. I mean, he's got a great hat. And then over here on the right, my mouse stops freaking out. We have Meet Kevin, another great hero. Now, he has 50% of his stock investments in Tesla, which is a fantastic way to invest your money. You definitely want to concentrate half of your portfolio in a massively overpriced meme stock. We go down, our next hero, and I actually found a video clip, Chris Sane. Now, this guy talks about the hottest stocks. So if you want to get rich quick, you should go subscribe to Chris Sane's channel. I mean, look at him. He's patting his head. That means he's smart. This is the guy you want to listen to pick your stocks to build wealth for the long run. And then last but not least, we have Stockmo. I mean, look at this picture right here. I don't know if you can see it very well, but he's doing some fantastic analysis. He's drawing a squiggly line on a piece of paper. This guy is awesome. His channel is called Stockmo, so go check him out. All of these gentlemen have taught me so much that I'm able to now build this spreadsheet for you. So, oh, do I have a formula issue right here? Whatever, it's too late. Anyway, so In this, in this spreadsheet, we're going to go over a theoretical growth stock and a theoretical value stock. And I'm going to show you why a change in interest rates or a change in the required rate of return will negatively impact a growth stock more. So on the top, my assumptions are the growth and the value company in this example have the same undiscounted future cash flows. So the growth stock is going to make $1,000 over the next 10 years. But the thing with growth stocks is they don't make a lot of money in the beginning because they're still growing, but people are buying future cash flows at a certain price point because they think the cash flows are going to grow and mature into the company's current high price to earnings ratio or valuation. And the value stock just has stable cash flows every year, $100, $100, $100 for 10 years. So both stocks will generate cash flows of $1,000 over the course of 10 years. The only difference is the growth stock's cash flows are clustered towards the later years, and the value stock's cash flows are clustered, or they're basically the same every year. Now, in this example, I said it's $1,000. So each company is going to make $1,000 or generate $1,000 of cash flow over the next 10 years. The time period, 10 years, and the current discount rate, which is the required rate of return. So we're going to discount the future cash flows at 10%. Now, what that means is if you pick a discount rate and you discount future cash flows, it's basically like compound interest, but in reverse. The further out the cash flow, the lower the present value of that cash flow. But if that's over your head, it's fine. But basically, the further out, the less that future money is worth because you have a required rate of return of $10. So we're going to discount all these cash flows at $10. So the growth stock, and don't get mad at my assumptions, okay? I just put this together very quickly. Now, for the growth stock, the cash flow for the growth stock in year one is going to be $1. Year two, $2, $3, $4, $5. And then they're going to have an explosion of cash flows. So I'm looking at this column right here. They're going to have an explosion of cash flows. God, my whole sheet got screwed up. Whatever. They're going to have an explosion of cash flows going all the way out to year 10. I don't know what happened to my sheet. Maybe me, Kevin, screwed it up, but that should say 10. Whatever. Now, the value stock is going to have steady cash flows going every year. $100, $100, $100. Now, let's see what happens if we change the discount rate from 10% to 11%. So you'll see these yellow numbers change because your required rate of return increases because of inflation or rising interest rates or whatever. So if we change this to 11, I really hope my sheet's not screwed up. You see how the numbers went down. So you put let's say let's go back to 10. Numbers go back to where they were. You change it to 11 and the discounted future cash flows change. Now, what does this all mean? Of course, my whole freaking sheet's screwed up. Damn. Whatever. I'm not stopping this video. Oh my God. Jesus. Hold on 1 second, ladies and gentlemen. See, this is why I shouldn't go live anymore. Let me fix this. All right. I fixed it. Now, here's what happened. At a 10% required rate of return, the buy point for the growth stock is $472.94. If you spend that much now and you discount the future cash flows for $1,000, you will get a 10% return. But if interest rates or whatever go up 1%, which increases your required rate of return, the buy point goes from 472 to 440. Now, the change is 6.76%. That's a pretty significant decrease for a 1% change. And once again, that's because future cash flows are clustered more into later years. So the discount factor affects those cash flows more negatively. Now, if you look at the value stock here, the buy point for the value stock was $614. And if you add or you increase the required rate of return by 1%, that drops to $588.92. That's only a 4% drop. Now, that should hopefully clarify. All right, Chris saying you're pissing me off. That should clarify why any slight uptick And interest rates, which increase the required rate of return because you want to beat treasuries, will ultimately have a bigger impact on growth stocks versus value stocks. So what may happen is if we're printing all this money and let's say inflation is bigger than people expect it to be, well, interest rates for treasuries might go up. And if that's the case, then the required rate of return for stock investors will also have to increase because you want to beat a treasury. If you can't beat a treasury, why buy the stock? And if that happens, growth stocks, especially like Tesla, whose cash flows, they're basically going to have huge cash flows way into the future. That's what people are projecting. If interest rates change, that's going to negatively impact Tesla and other growth companies significantly. So that's why I, as an investor, I like to buy everything, growth, value, because I don't freaking know what's going to happen. But I'm not going to concentrate my portfolio in all growth stocks that have performed well recently just because they've done good. Because any change in interest rates, an increase could significantly hurt growth stocks. Hope that all makes sense. I'm kind of pissed that my freaking spreadsheet didn't work. But that's basically it. No questions? If you liked it, please like the video, subscribe to my channel, and buy my book, Stop Being a Broke Loser. It's on Amazon for $3. And y'all have a wonderful day. Jesus.